Pricing is a critical component of a business's overall financial management, and standard costing plays a significant role in shaping these decisions. Standard costing is a method used in managerial accounting to estimate the cost of manufacturing product or providing services. By setting predetermined or standard costs for direct materials, direct labor, and manufacturing overhead, companies can use this information to determine the optimal pricing for their offerings. The influence of standard costs on pricing. One of the primary ways that standard costing influences pricing strategies is through the calculation of the cost of goods sold. By understanding the standard costs associated with producing a product, businesses can accurately determine their COGS and use this information to set prices that will provide the desired profit margin. This is especially important in industries where profit margins are tight, and even small changes in costs can have a significant impact on the bottom line. For example, let's consider a manufacturing company that produces a line of high-end kitchen appliances. The company has carefully calculated the standard costs for the materials, labor, and overhead associated with each appliance model. Armed with this information, the finance team can work closely with the marketing and sales departments to set prices that not only cover the standard costs, but also allow for a comfortable profit margin. Additionally, standard costing can be used to compare the costs of different product lines or SKUs within a company's portfolio. This information can then be used to inform pricing decisions, allowing businesses to charge higher prices for products with lower standard costs, or alternatively, to offer more competitive pricing for products with higher standard costs to remain competitive in the market. Imagine a clothing retailer with a diverse product line, ranging from basic t-shirts to high-end evening gowns. By analyzing the standard costs for each product category, the retailer can identify the most profitable items and price them accordingly, while also offering more competitive pricing on the lower margin products to attract customers and drive sales. Risks of over-reliance on standard costs for pricing. While standard costing can be a valuable tool for pricing decisions, there are also risks associated with relying too heavily on this method, particularly in highly competitive markets. One of the primary concerns is that standard costs may not accurately reflect the true cost of production, which can lead to pricing decisions that are not aligned with the market or customer demand. For example, if a company's standard costs are based on outdated or inaccurate information, such as historical prices for raw materials or labor rates, it may be pricing its products either too high or too low compared to the competition. This can result in lost sales opportunities or reduced profitability, depending on the direction of the pricing discrepancy. Imagine a furniture manufacturer that has been using the same standard cost for its products for several years. During this time, the prices of key raw materials, such as wood and metal, have fluctuated significantly due to global supply chain disruptions. If the company fails to update its standard costs to reflect these changes, it may be pricing its products at a level that is no longer competitive in the market, leading to lost sales and market share. Furthermore, in highly dynamic markets where the competitive landscape is constantly shifting, relying solely on standard costs for pricing can make it challenging for a business to remain agile and responsive to changes in the market. Competitors may be able to adjust their pricing more quickly based on real-time cost data, leaving a company that is heavily dependent on standard costs at a disadvantage. Visualize a tech startup operating in the rapidly evolving software as a service industry. While the company may have carefully calculated the standard costs for its platform, the market conditions and customer preferences can shift quickly, with new competitors entering the space and pricing their offerings more competitively. If the startup fails to consider these dynamic factors and relies too heavily on its standard cost-based pricing, it may struggle to maintain its market position and profitability. Balancing standard costs and market conditions. To effectively leverage standard costing in their pricing strategies, businesses must strike a balance between the insights provided by this method and the realities of the competitive market. This may involve regularly reviewing and updating standard costs to ensure they accurately reflect current conditions, as well as incorporating other factors, such as customer willingness to pay, competitor pricing, and overall market trends, into the pricing decision-making process. One way that companies can achieve this balance is by adopting a flexible, data-driven approach to pricing. This might involve using advanced analytics tools to monitor market conditions, customer behavior, and competitor pricing in real time, and then adjusting their own prices accordingly. By combining the insights from standard costing with a deep understanding of the market and customer needs, businesses can develop pricing strategies that optimize profitability while remaining competitive. Consider the case of an online retailer that sells a wide range of consumer electronics. The company may use standard costing to calculate the COGS for each product in its inventory, but it also leverages sophisticated pricing algorithms that consider factors such as demand, seasonality, and competitor pricing to dynamically adjust its prices in response to changes in the market. This allows the retailer to maintain healthy profit margins while still offering competitive prices to its customers. Additionally, companies may consider using more flexible pricing strategies, such as dynamic or value based pricing, which can help them adapt to changing market conditions more quickly than a rigid, cost based approach. By understanding the value that their product or services provide to customers and tailoring their pricing accordingly, businesses can create a more nuanced and responsive pricing strategy that goes beyond simply relying on standard costs. Imagine a software company that offers a suite of productivity tools. Rather than setting a fixed price for each tool based on standard costing, the company may employ a value based pricing model that adjusts the price based on the specific needs and use cases of each customer. This allows the company to capture the true value of its offerings while remaining responsive to changes in the market and customer preferences. Conclusion. In conclusion, standard costing is a valuable tool for informing pricing decisions, but it should not be the sole factor considered. Businesses must carefully balance the insights provided by standard cost with a comprehensive understanding of the market, customer preferences, and competitive dynamics to develop pricing strategies that support their overall financial and strategic objectives. By combining the power of standard costing with a flexible, data-driven approach to pricing, companies can optimize their profitability while maintaining a competitive edge in the market. This requires a deep understanding of both the internal cost structure and the external market forces, as well as the willingness to continuously adapt and refine pricing strategies in response to changing conditions. As the business landscape continues to evolve, the ability to effectively leverage standard costing and other pricing methodologies will become increasingly critical for companies seeking to thrive in a highly competitive and dynamic environment. By mastering this delicate balance, businesses can unlock the true potential of their pricing strategies and drive sustainable growth and profitability.